But it's a market like that. Let's try and find out how do pure play equity investors how do some of the noted pure play equity investors approach this market. Gautam Sinha, Senior Vice President at Motilal Oswal Asset Management, joins us right now on the show. Gautam, good having you. Thanks so much for joining in. I know in equity markets, one should have a really long-term view, and that gives you the best returns or the best bang for your buck. But do periods like these tend to disturb the apple cart in a meaningful way? The last 2.5 odd months, or at least the last 2.5 odd weeks, we're seeing almost every rise being sold into. A lot of people are talking about how there are lower levels up ahead. What are you doing with the kind of money that is coming into your funds? Because you guys are pure play equity players.
After a while, we are very happy. Long-term investors always love a sale season. And this is a pure sales season, not only at the index level, but at individual stocks too. You're seeing some serious discounts coming in. So it's a very good time to have your buying list ready and keep monitoring the market, keep looking out for opportunities. Market is giving us opportunity to buy at good prices, I would say. And be long-term investors. Don't buy for the next 1 month, because then you could be seriously hurt. But have the appetite to hold on for 3 years, and in select stocks, at the right levels, do come in. This is a good time to start coming back into markets, right? Because previous quarter valuations had become quite expensive. Now I think even at the Nifty level, we might be plus 1 standard deviation above the long-term mean, which is fine, and which essentially means that in individual stocks you get good opportunities. You have to be selective still. It's not a kind of market where you buy anything and you're going to make money over the next 2-3 years. That's not the case yet, obviously. It's still an expensive market, but it is not obnoxiously expensive like it was a couple of months back. And this is a market which is giving you opportunities to buy it. So I'm very happy about it.
Since you're looking to buy at these levels, Gautam, I'm sure you're not going to share the stock names, but which are the sectors, or let's say the investment themes that you guys are targeting at these lower levels?
Incrementally, I think what happened at PNB and everything, retail financials, retail private banks, given how strong those franchises are, how well run they are compared to competition, which is PSU banks, which is almost like 3/4 of the system of the credit market, right? And these guys are 1/4 of the credit market. If 1/4 of the credit market, the player is so much more efficient than the 3/4 guy, I mean, that market share shift will be accelerated only going forward. And not only that, it will also be aided by technology, right? Which will have enormously positive impact on the operating cost, operating leverage of the retail financial banks. So this is a space that you would know that our portfolios are hugely bullish on. This also plays into penetration of consumption theme in India, financed consumption or loan-based consumption. That is an ongoing theme. So that space looks exciting. Oil marketing looks cheap, really cheap, less than 10 PE cheap. So that's another area that we continue to like. Even the gas plays have corrected, so they're looking quite good. These are long-term structural stories which are not going to fade out anytime soon. So I continue to invest in these spaces. I think contra call would be IT and pharma. If you look at 9 months earnings, this year earnings, IT pharma has been the biggest negative surprise, or not a surprise, negatives on index earnings or Nifty 100 earnings. So I think going forward, there's a good chance that in select IT stocks and select pharma stocks, the earnings trajectory will improve from here. And mind you, these are very high quality franchises, extremely moated. They were suffering because of some reasons which had been playing on the stocks for a while. I think the worst is over for these sectors, and could be a good time to start relooking, but selectively, stock specific. You cannot be very stock agnostic in these sectors, because some of the things have changed very fundamentally. Some of the sector dynamics have changed very fundamentally, but these are good sectors to look at now.
Okay, interesting. Wanted to talk about a couple of things, Gautam, with you. Since you mentioned banks, I mean, there is a clear dichotomy. I wonder if this means that money will stop coming to the space by and large, because almost everybody that we speak to does not want to touch PSU banks with a barge pole. Corporate-facing banks are better valued right now, but still not. There is not enough clarity for people to go out and put money to work. And the retail-facing banks, which are probably the safest of the lot, are arguably trading at valuations which are very, very expensive. So if somebody wants to put money to work in the banking space, what does he or she do? I mean, if you get money right now in droves, and if you want to put this money to work, what do you do?
Yeah, it's a very, very easy answer, Neeraj. Go for the third bucket. The retail-facing banks had become extremely expensive. They remain expensive, but there has been a bit of time correction, 6 months. And time correction in companies which are compounding at 30% is a very good thing, because 6 months hence they are not very expensive, because there has been a 15% kind of valuation correction which has happened automatically. So I think from a competitive advantage perspective, competitive advantage of these banks vis-a-vis the extant PSU bank competition is only increasing. That is definitely true, and incremental credit market share gains will be enormous. There are operating leverage benefits because of technology-driven OPEX cost reduction, and also the liability franchises have become very strong, which reflects in the CASA of some of these banks. So clearly, these are from a earnings growth perspective, these will be some of the best earnings growth names in India over the next decade. And from valuation perspective, yes, when the market clearly sees a very long trajectory of very strong earnings growth, it somewhere reflects in valuation. You have to live with that, but still you'll make good money from a long-term perspective in this space. The red herring, of course, are the private, traditionally corporate-oriented banks, which are also, by the way, trying to increase their retail presence now, which have focused on retail much more in the last 5 years. But they have big problems on the corporate exposure that they have historically had. I think these names are also slow turnarounds, right? They will take time, but some of them might really give decent returns, given that valuations are also cheap there. PSU banks have their set of problems, so PSU banks would essentially continue to be trading names where if you get the valuation seriously right, you get a good bang for the buck over the next 6 months or the next year. But that's the way to look at PSU banks right now. The structural problems are getting sorted, but that takes a lot of time. That's a very slow process given the extent of the problems that they have. On the NPA side, now with the recent development, you're also worried on some of the operational risk that is there, but I'm sure that things will turn around for PSU banks too. But it will take time, and there's no point in being in a hurry to catch that trade.
Gautam, the big question is actually when will the things turn? The street was turning positive after the recapitalization news, but post the PNB fraud case, we've seen a huge correction for all these PSU banking stock. And you did mention they can be a valuation bet because most of them are trading at a cheaper valuation. But keeping all that in mind, even the earnings have not been so good of these PSU banks, especially State Bank of India in Q3 disappointed the street. Would you still go ahead and take a bet only because the valuations are cheap?
Seriously, I own because my style of investing is very oriented towards long-term earnings compounders. So that aspect is still not visible here. But if someone had to look at PSU banks today as trading bets, that would largely be a valuation call. And sometimes, you do find very attractive underpriced assets at such times, especially when there is so much of negativity, so much of scare around the entire set of PSU banks. So if you have that attitude towards money making, sure, go ahead and find a few names. Maybe not today, but maybe over the coming quarter or so. But that obviously is not reflective of what I will do, because that's not clearly my style. But from a valuation perspective, there is now some attraction in this space.
The other piece, and by the way, the charts that we are going to use, viewers, are only an example. We're not going to be talking to Gautam Sinha about Page Industries, to be honest. But Gautam, I'm using that as an example just to bring out, how people should approach companies which over the years have shown tremendous growth, now the revenue growth may start coming off a bit because the size has gone up. Maybe return ratios might still stay stable, but the revenue growth might come off a bit. Maybe the dividend yields, obviously because of the higher price, will come off a bit. Whether all of these factors lead to a bit of a destruction in the kind of multiples that some of these companies enjoy, because hitherto there was never a question mark about an X P multiple for an X motorbike company or a specialty garment company or a retail company. With time, with 10, 15, 20 years, do these multiples tend to come off a bit?
So, if you look at, let's say, the example of Indian IT services, the last half of the 90s decade, 1990s decade, was the period of hypergrowth for Indian IT services. And the P multiples were also reflective of that kind of hypergrowth. And ever since the peak growth would have been achieved in early 2000s, the P ratios over a period of time gradually came off. And this is just an example which comes to my mind of the curve, but across sectors, what happens is essentially, new concept, underpenetrated story, underpenetrated product, underpenetrated business idea comes in. And people overestimate, people are not able to fathom the opportunity size, the extent of growth, the longevity of growth, and valuations at that period can be humongous. This is the exploding growth period of the company, where even triple-digit P ratios are possible, and that sustains for a period. Eventually, market wakes up to the fact that there are limits of growth in every business, and that's when the P contraction game starts. So even in that period, that's a very dangerous period, because even while growth is good, the P is contracting, so could nullify each other. So that happens in product category, business after business. So one has to be very mindful of owning such stocks. Whenever you own a stock with a very high PE, you have to be able to justify that PE, irrespective of the quality of the business, irrespective of the fact that growth is going to be stupendous. But how stupendous is the growth is the key question there. Is it good enough to compensate for the PE that it is trading at? That's a very difficult question. That's almost like a fine art, because you're talking about future growth, right? So, and a 5% plus minus growth rate in the future can make a huge difference to the current fair value of that stock. So that's a question for investors to continuously debate on, people who are holding such stocks. But the general idea is absolutely right, Neeraj, that as the hypergrowth period gets over and the company or the business goes back down to normative growth rates, P ratios have to compress. That has to happen.
So beware of such themes as and when they do come out, because as Gautam Sinha rightly says, that could be a very painful period. I'm glad we had this conversation, Gautam. Really appreciate you taking the time out and speaking with us today on Bloomberg Quint. Thanks for that. Well, that's Gautam Sinha from Motilal Oswal AMC. Well, speaking of hypergrowth, there is hypergrowth in sugar production for sure.